Hi, my name is Donnell Green. I'm a mortgage loan officer, and let's talk finance. Today, we're going to discuss the 5 C's of credit, what they are, how they're used, and why they're important. The 5 C's of credit is a system used by lenders to gauge the creditworthiness of potential borrowers. These are 5 characteristics of the borrowers and conditions of the loan that are evaluated to determine the chance of default and the risk of financial loss for the lender. The 5 C's of credit are going to be character, capacity, capital, collateral, and conditions. First, let's talk about the first C, which is character. Character, that's more specifically is going to refer to credit history, which is the borrower's reputation or track record for repaying debts. The information is going to appear on the borrower's credit reports, which is generated by the 3 major credit bureaus. Sure, we all are knowledgeable of them: Equifax, TransUnion, and Experian. Credit reports are going to contain detailed information about how much an applicant has borrowed in the past and whether they have paid their loans on time. These reports will contain information on collection accounts, bankruptcies, and they're going to retain that information for 7 up to 10 years. So information on these reports are going to help lenders evaluate the borrower's credit risk. Next, the second C, we have capacity. Capacity is going to measure the borrower's ability to repay the loan by comparing income against recurring debts and assessing the borrower's debt to income ratio, otherwise known as DTI. Lenders are going to calculate DTI by adding the borrower's total monthly debt payments and dividing that by the borrower's total monthly income. The lower an applicant's DTI, the better the chance of qualifying for a new loan. Qualifying for a new mortgage typically is going to require a borrower to have a DTI of 43% or lower, but sometimes that can go higher depending on compensating factors. But that's going to ensure that the borrower can comfortably afford those mortgage payments for the new loan they're looking to take on. Third, we have capital. Capital, that's going to basically, with that, lenders are going to consider any capital that the borrower is going to put towards the potential investment. A larger capital contribution by the borrower is to decrease the chance of default. Borrowers that can put down a down payment on a home typically find it easier to receive a mortgage. Capital contributions indicate the borrower's level of investment, which can make lenders more comfortable about extending credit to that borrower. Down payment size can also affect the rates and terms of a borrower's loan. Generally, larger down payments or larger capital contributions result in better rates and terms. With mortgages, for example, down payments of 20% or more should help a borrower avoid the requirement to purchase additional private mortgage insurance. Fourth C we have is collateral. Collateral can help a borrower secure loans. It gives the lender the assurance that if the borrower defaults on the loan, the lender can get something back by repossessing the collateral. The collateral is often the object which is being borrowed upon. So, for example, auto loans, it's going to be secured by the vehicle, and mortgages are going to be secured by the home. So those will be the collateral on those type of loans. Loans secured by collateral are sometimes referred to as secured loans or secured debt. These are generally considered to be less risky for lenders to issue. As a result, these loans are secured by some form of collateral commonly offered with lower interest rates and better terms compared to unsecured forms of financing like unsecured credit cards or personal loans. And the last C that we have is conditions. Conditions, in addition to the lender examining your income, lenders also going to look at general conditions relating to the loan. This may include the length of time that the applicant has been employed at their current job, how their industry is performing, their future job stability. All these are different factors that they're going to take a look at. Lenders are going to consider how you plan on using the money. So a lender may be more willing to lend for a specific purpose, such as a home purchase or a business loan, as opposed to a personal loan that can pretty much be used for anything. So lenders may also look at the conditions outside of your control, like the economy and federal interest rates and industry trends. So these things are also going to impact you. So you just be aware of these things before applying for credit. While you can't control these things, it's just good to know how lenders are going to evaluate your risk. So as a recap, character, first C, it's going to develop a strong credit history. You always want to make sure that you make your payments on time, and also keep your credit utilization, which measures how much credit you're using. You want to keep that very low if possible. Capacity, the second C, only apply for credit that you need. A low DTI ratio can help lenders, can help show the lender that you have the capacity for a new loan payment. The third C, capital, having cash on hand may help you qualify for a loan, because it can show lenders that how invested you are into that new loan that you're looking for. The fourth C, we have collateral. You may need to provide collateral to take out new loans or credit cards. If you always want to make your payments on time and follow the loan terms. If you do that, you get to keep your collateral. So that's the whole purpose. You want to make sure you get what you're applying for, that house, that car. You want to keep it. You don't want to have a repossession. You don't want to have a foreclosure. So that's really important to make sure that you stay on top of those payments and the terms that you agreed to. And last, conditions, the last and final C, you might not have control over some of these things, but it will impact your credit application. So being aware of them can just give you an idea of whether you might qualify for credit or not. So I hope this video provides you with some new information for financial literacy. If you like it, please share it with your friends and family. Also follow my page and turn on post notifications.